Hello, fellow Rebel Capitalists. Hope you're well. So we have Apollo Group coming out today and saying it's all bad. All of it. Every single loan in the private credit space should be marked down to 20, maybe 40 cents on the dollar. Oh, here we go. Let's dive right in. And this comes straight from an executive at Apollo Group, which is right up there with KKR and not as big as BlackRock, but he kind of said the quiet part out loud. So let's get into it. And I wish that was the worst news of the day, but it's actually not, because what investors have started to do is dive into the black box that is Cliffwater. Now, if you haven't been following this, Cliffwater is the most recent cockroach. This is the most recent private credit fund, large, huge, $40 billion fund to really have problems. And it shows you the systemic risks involved. Anyone that says this is contained has no idea what they're talking about. So let's get into the first Wall Street Journal article here. And that's top Apollo executive sounds off an arrogance in private markets. I don't know why that's the headline, because the headline should be that every single one of these, or right here, I literally think all the marks are wrong. Not some. So what he's saying here is he's saying the valuations of these loans, he thinks they're all wrong. All of them. Meaning not one of them should be valued at 100 cents on the dollar. And this is according to John Zito. And he said of private equity in previous unreported comments. Apollo says comments were about the software companies, which is a significant portion of these outstanding loans that are on the balance sheets of these private credit middlemen. I don't know what you want to call them now. So executives at the biggest private credit lender have sought, I didn't know they were the biggest. Okay, so they're not as big in terms of size as BlackRock, but I guess in this space, they're the biggest private credit lender. Okay, have sought to play down the exodus of investor money. So what's interesting is this is all PR, obviously. They're trying to take a different approach. Instead of coming out and saying that, oh, nothing to see here, just everything is 100 cents on the dollar and anything else is just fear-mongering. They're taking a different approach because now they have to, right? We're kind of past that Biden moment where you can dupe retail investors or investors, any investors, into thinking this isn't a problem. So now they're trying to take a different approach by coming out and admitting that there is a problem, but saying that they're the best positioned to handle the collapse. That's effectively what they say. They say this is all going to hit the fan, but when it does hit the fan, we'll be in a good position because we have a lot of cash on our balance sheet, so we can buy things at pennies on the dollar when the whole crisis comes about. That's basically what they're saying. Let's keep going here. So John Zito is co-president of the firm's asset management arm that is one of the private credit's largest players, spoke more bluntly in previous unreported discussions. Yeah, you could say that more bluntly. That's putting it mildly. He called it arrogance in private markets. Exuberance is what I'd call it. Just go back to Greenspan. It's the exact same thing. Exact same thing. It's this irrational exuberance. And so what happens is the tide comes in. The tide comes in and everybody wants to keep drinking from the punch bowl, right? And so what happened, times are good, everybody's making money, you got AUM coming in, all this capital is flowing from pension funds and from retail investors, and everyone's making these huge bonuses and buying the brand new Lambos and the Ferraris, and let the good times roll, baby. So what happens is you have so much money coming in that you have to deploy it. It's not like you can be one of these funds and sit there and say, oh, go ahead and pay me 2 and 20 because I'm going to park it in T-bills because I think there's a little bit of excessive risk in the market. They can't do that. The investors aren't going to pay 2 and 20, their fee, 2% management fee, then 20% of the upside, just to have you park the capital into T-bills. So you got to do something with it. So what happens is the first thing to go are lending standards. It's like war. The first casualty of war is the truth. We're seeing that in spades in Iran right now. The first casualty of all this money coming into the private credit funds is lending standards. That's the first casualty, underwriting. Because if you get in the way and try to underwrite some of these deals, and then you say, oh, no, this isn't a good deal. You say, just make it a good deal. Well, why do I have to make it a good deal? Our investors are going to lose money. It doesn't matter. Just pretty it up. Put lipstick on a pig. Because we have all this money that we have to allocate. So we either allocate it to this pig with lipstick, or we allocate it to that pig with lipstick. So all the other pigs are a 1 on a scale of 1 to 10 as far as underwriting. So if this one's a 2, well, that's the best choice we have. That's basically what happened. And then they, of course, why do underwriting when everyone knows that money is just going to keep, all these investments are just going to work out because the economy is on fire. The economy is booming. And who cares? Because if we do take a hit, well, then that's going to be pawned off on the investors. And if we really take a hit and get in trouble, we're going to get bailed out by the Fed. It's the free call option is what I call it all the time. So again, I don't know that I'd call it arrogance. I'd call it just pure hubris and exuberance. So Zito is coming out and pointing his finger at all the other guys, but look what he says. He believes that his own private credit business is on solid footing. Oh, of course it is. See, this is the gradual progression. It's the very first thing you do in the cycle when everyone starts smelling smoke is you tell them they're crazy. You kind of gaslight them. Oh, what are you talking about? There's nothing wrong with our balance sheet. There's nothing wrong with these assets. These things are rock solid. That's the first strategy. That's the first part of the script, right? But pretty soon, the whole room is filled with smoke. So you can't deny that there's no smoke anymore. So then the next part, the next script that you get is to go ahead and admit that there is a lot of smoke and there's likely fire, but it just doesn't pertain to you because you were the guy that made all the smart decisions. You were the guy that was prudent with all the investor capital. It was all those other guys out there that made the bad decisions. And then the third phase here is everyone admits that they're screwed, their tits up, and beg for a bailout from the Fed. That's how this usually this movie plays out. Okay. So Zito talked about the large sell-off with large software companies was largely sparked by fears about AI. He cautioned the smaller software companies bought by private equity, many with private credit loans, could face even more challenging conditions, which makes sense because you're sitting there looking at the share price of Adobe or Intuit, like QuickBooks, and you're like, why are these guys even going to exist in 5 years with AI? But what he's saying here is, yeah, you're looking at Intuit and at Adobe. Try looking at the companies that are 1/100th of the size. If you think Adobe isn't going to be here in 5 years, and they have $5 billion of cash on their balance sheet, what do you think is going to happen to this middle market guy that's just struggling to get by that hasn't even turned a profit yet? I mean, what is so amazing about this is it's the same cycle over and over and over again. It's like you do this, you wait 15 years, everyone forgets about it, everyone gets greedy, makes the exact same mistakes, and then the stuff hits the fan, and then you go another 15 years. I mean, it's like, do we not learn anything? The answer is no, because the reason why these cycles are so consistent, the reason why these cycles are so predictable is because they're based on human nature and human hardwiring. And that's never going to change. Never. So let's see. What are we talking about now? Several lenders to Medallia. Ooh, that sounds impressive. According to Apollo, have already written down its debt. There will be an issue, is a quote, with respect to that credit, which I think will be worse than people expect. So you think that, oh, all the bad news is priced into these shares. This guy's saying, no, it's not. It absolutely, unequivocally is not. So then I love this PR move. First of all, he says that yes, there's a lot of smoke. We admit, yes, there's a lot of fire, but it's just everyone else that made these bad decisions. Although we are going to have to write down a lot of our loans. He admits that in the article. And then he concludes by saying, well, but the loans that we're going to originate in the next 10 to 18 months, well, these things are going to be awesome. So don't pull your money out now. That's basically the message here. I mean, come on, dude. And you know what's really annoying, what pisses me off, is he says this. I mean, first of all, at least he's being a little more honest than his competitors. But it's like, come on, dude. You know you're on the Titanic. You know this is a Titanic. And you know the only way the investors are going to get their money back is if just some miraculous Hail Mary works out. You know that. But instead of telling people that and letting them take their money out now to at least get 70 cents on the dollar, you're lying to them and trying to pull the wool over their eyes to where there's a 99% chance that they'll get no money back. I mean, that, to me, that rubs me the wrong way. I think that's completely immoral, totally unethical. Might be legal, but it might not even be legal. I don't know. I'm not a lawyer. And but now sympathy for the devil. These guys are in a tough position, but they put themselves in that position. So it's tough to have a lot of sympathy for them, but think about where they are right now. Like, what would you do? He says making a decision in one quarter may be the right decision for fundraising in near term. And then a quarter later, you realize it was a really bad decision. So he's talking about if the fund gets more than 5% of the redemptions, which is usually kind of the threshold, that they'll allow 5% redemptions per quarter. But anything more than that, they will not allow, because it would force them to fire sell assets and take the actual price that these things are worth, which is pennies on the dollar. And then it just becomes a doom loop, a death spiral from there. So he says, my overall bias is to stick with 5% to protect all my existing investors. What is he really saying there? He's saying that if we allowed the amount of redemption requests that we have, we would have to sell things at the real price. And the other investors that were too stupid to pull their money out or just couldn't pull their money out for some reason would be left holding the bag, and there'd be zero money in that bag. That's what he's saying here. Check this out. Some might say private equity funds are built assuming that some bad deals and some home runs. So basically like angel investing. While credit funds tend to be, so private equity versus private credit. So private credit funds tend to be designed. I wouldn't say they're designed, they're marketed. Way different there. They're marketed as a way to deliver predictable returns. Asked where he sees the pain in Apollo's private equity portfolio or those of other firms, Zito says, and listen to this, I literally think all the marks are wrong. Is that what you're asking me? I think private equity marks are wrong. So every single valuation of an equity position they have, of debt that they lent out, it's all mismarked, meaning too high, not too low. And so, I mean, he's basically admitting that they've been lying to investors and that here's the truth, but tough luck because you can't have your money back. unless you're part of the lucky 5% that just happened to see this and run for the exit 3 months ago. And by the way, when we get into this next Wall Street Journal article, you're going to see how this next one is going to completely blow your mind. It's going to scare the hell out of you. It's going to absolutely scare the hell out of you. Trust me, if you were bearish prior to watching this video, you weren't even close to bearish enough, unfortunately. So he says, we believe software valuations do not reflect first quarter market conditions. So although the software prices maybe have come down 20 or 30%, he says that's still not even close to low enough. And that's for the big players, the ones that actually make a profit. Not to mention all of these middlemen or middle market guys and smaller businesses who haven't turned a profit and have no hope of turning a profit, but yet somehow the investments to these businesses are marked at 100 cents on the dollar. And he admits what he told his wife. He says the amount of dispersion going on beneath the surface is kind of crazy. I literally at home told my wife last night, I feel like the market should be down at least 10% and it's flat or up. Join the club. Join the club, Zito. You must be a Rebel Capitalist subscriber. Exactly. But we just have to understand that there's a complete disconnect. And first of all, the stock market is a lagging indicator. And there's a huge disconnect between what's happening in private credit, what's happening in the real economy, and of course, what's happening in the stock market. But at some point in time, the chickens come home to roost, right? We saw that with the GFC. We see it in every single credit cycle. We saw it in .com. We'll likely see it here as well. He says, on our balance sheet, we're 95% investment grade. Okay, ask yourself, who determines whether or not you're investment grade? Remember back in 2008? Remember all of the mortgage-backed securities, they were all AAA rated. So you can go out there and market it to your investors. Oh, look, this is investment grade. Well, what does that even mean? Just because you label it investment grade, that means that it's investment grade? Of course not. That's like that's like a steak company being able to grade the level of their beef and say that it's organic. Well, it's coming from you. Of course you're going to say that. What are you going to say? Now, let me get some third party to actually do it. And by the way, a third party that isn't paid by you. If you remember going back to the GFC and how that played out, that all the ratings agencies were getting paid under the table, right, for those AAA ratings. So then the funds could take those AAA ratings and going to their investors and show them how there's absolutely no risk. When 3 months later, they give them the old slip saying that, sorry, your investment is worth $0 now. He says, but inevitably, if we're in a really bad recession, which he thinks we're going into, I'm certain we'll have nicks as well as other people. But I think we're going to come out much better. Here's where he, in a way, not in a way, he pretty much admits that stuff's going to hit the fan, and to a degree to which maybe you have a GFC type event, but at the very least, he's able to go in there and pick up other funds or other assets at pennies on the dollar. Well, if he's able to do that, what does that tell you about what he sees happening in the future? Not just with the economy, but with the credit cycle, with the with the financials, with maybe even the stock market. Here's his exact quote here. But I think we're going to come out much better. And I think we are going to be able to have the flexibility to buy stuff over that time period that makes us significant amounts of capital. Again, translation, we have enough cash on our balance sheet to hopefully weather the storm. And we see a big storm brewing to the point where we're going to be able to pick off these assets for pennies on the dollar, because it's going to get bad. It's going to get really bad. And if you ask yourself how bad, trust me, you don't know the half of it. Because now let's go over to the second article where we go into the black box that is the $42 billion fund that just announced they're having the exact same problems, that they're one of the cockroaches, last Friday. It was either last Thursday or last Friday, and that's Cliffwater. So it says Cliffwater's funds opacity. They all have this problem. It's not just Cliffwater, it's all of them. I love this. One reason many are rushing for the exits are the disclosures at the fund like this often are as impenetrable. That's a good word to use when you're trying to analyze the assets of an investment vehicle or a fund where you just gave the guy all of your money. They are as impenetrable as they are voluminous. Boy, those are tough words to pronounce, but you get it, right? This is what you don't want to see if you are an investor, is that a black box that is their balance sheet that is impenetrable and voluminous. Voluminous. There you go. I'll leave it at that. Let's keep going. Cliffwater's fund, most recent quarter report listed, check this out, 3,600 individual holdings. So if you're an investor that was stupid enough to give them your money and you're like, okay, guys, I'm getting a little worried. Let me look beneath the hood. Let me see some of these investments that you guys made and let me look at their balance sheets. Oh, here you go. Here's 3,600. How could you possibly find 3,600 good deals to invest in that weren't risky? How is that even possible? The answer is it's not. It goes back to what we were saying before, is that you're having money thrown at you and you have to deploy it. You don't have a choice. And so what that leads to is not just bad underwriting, it leads to no underwriting. With 42 billion of total assets at year end and 31 billion of net assets, here's where you're going to start to get pissed off. So here's where you need to sit down and pour yourself that stiff drink. Cliffwater Fund is the largest SEC registered private credit interval fund, according to Interval Fund Tracker. Its trustees, until last year, included Paul Atkins. Now you say, George, I don't know that name. Who is Paul Atkins? Oh, he's the guy that resigned from the fund's board. Why? Because he got a job as the SEC chairman in April of 2025. So this is the wolf watching the hen house, or the fox watching the hen house. Whatever the phrase is, this is it. So you see how incestuous this is. These private credit guys, these funds, they know they're all going to blow up. None of them want to go to jail. So they're like, oh, hey, I've got a good idea. Let's somehow dupe or pay off whoever we need to in order to get one of our guys in charge of the SEC. We want to get one of our buddies in charge of the SEC. We want one of our buddies watching the hen house. So we can keep doing this. And if we do blow up, there's no chance that we go to jail. That's literally what's happening. Oh, but wait, there is more. It gets worse. Listen to this. And you may be asking yourself, well, George, why would they want one of their cronies, one of their boys at the SEC? This is why. The Cliffwater Fund first bought a stake in another private lending fund, the circular economy, called Ares Commercial Finance in 2021. Since then, it had consistently told investors that Ares Fund would liquidate June 30th, 2025. Okay, so just so you guys are following, you've got Cliffwater. They're saying, oh, we're going to make this awesome investment. Okay, you're lending to a company? Not really. Not really. We're going to lend to another private credit lender. Oh, well, that makes a lot of sense. So then what happens is they say, but don't worry, because this fund that we're investing in is scheduled to liquidate June 30th. And when they liquidate, we're going to get all of our money back plus more. because they're making all of these awesome investments that are totally risk-free. And then we're going to have all this liquidity to pay back our investors just in case, for some irrational reason, they might want a redemption. That's gets you up to where we are right now in the story. But here's what happened. Over the years, Cliffwater kept adding to its stake. Oh, wow. You kept adding. Well, that must mean that it was really paying off and you saw the opportunity. But then what happened? June 30th came and went. Remember, that was when the fund that they were investing in was supposed to liquidate, so they'd get all their money back plus the profits. Cliffwater said that it still owned its stake in Ares and that the value of its ownership stake kept rising. Well, how? If the Ares fund liquidated June 30th, how do you still have an equity position? And how is that still going up in price? It's a little bit of a head scratcher, isn't it? As of September 30th, Cliffwater reported so mind you, they're supposed to liquidate June 30th, but as of September 30th, Cliffwater reported an $11 million unrealized gain. They're all unrealized gains because, pardon my French, they're all bullshit. They're every single one of these things is bullshit because they're not a publicly traded company. So the valuation is just whatever Cliffwater tells you it is. And oh, but wait, it's worse because it's not the valuation that Cliffwater tells you it is. It's the valuation that Ares tells Cliffwater that Cliffwater tells you. I mean, this is the insanity. It's one of those things that we look back, hindsight being 2020, and we say, what the hell were people thinking? A disclosure table said that it had a $64.9 million fair value. And the investment, the original investment, was $53 million. And that the fund term was until the final liquidating distributions of the fund June 30th. Whoops. That came and went. No money. That indicated the Ares fund shouldn't have existed anymore, barring further explanation. So let's just say that the Ares fund didn't liquidate. Why? Because they couldn't. Because if they sold, there's nothing there. It's all fugazis. It's all fugazis. It doesn't exist. And if it does exist, it's pennies on the dollar. Because if it wasn't pennies on the dollar, if it was true what they were telling you, they would have liquidated the fund. Oh, but wait, there's more. You see, 3 months later, Cliffwater said the investment in Ares had a cost of 98. So they continued to dump money into it and was worth 111. The paper gain had climbed to $12.8 million. So they're just taking these fugazis and they're just telling you that these fugazis are actually more and more money that you're making. But the fugazis don't exist. They say insight into the fund's valuation is extremely limited. You don't say, because they don't tell you what it is. There's no mark to market because there's no market for these things. It's just, you've got to take their word for it. Cliffwater in its December 31st report said 29.7 billion or 71% of its investments were level 3. What is level 3? Oh, wow, level 3. That sounds serious. Level 3, that sounds like you did a lot of underwriting. So they just make up these marketing terms that don't mean anything. And then they sit there and tell their investors, oh, don't worry, because 29% or $29 billion, 71% of our fund is level 3. So you have nothing to worry about. Well, what's level 3? Oh, well, we can't disclose that to a pleb because there's no way you would understand our complex algorithm. And the complex algorithm is bullshit. Meaning that they included inputs and that Here's where we let the cat out of the bag. Here's what level 3 is, meaning they included inputs that are both significant and unobservable. Unobservable. Now you understand why they wanted their buddies in charge of the SEC, or at least a higher up at the SEC. It is common for companies to use pricing models to value assets that lack market quotes. Well, then how are you doing it? If you don't have any market quotes, how are you pricing? Like what's going into your model? And here it is. It often requires making assumptions. Right. And do you think those assumptions are going to be overly optimistic? Answer, yes. A further 11.6 billion, or 28% of the fund's investments, were in other private investment vehicles. So it's the infinite money glitch. Geez, such as the Ares Fund. For those holdings, Cliffwater said it relied on the net asset values provided by other fund managers rather than trying to estimate the value on its own. Reliance on NAV, net asset value report, by other managers epitomizes black box financial reporting. Investors not only have to take the Cliffwater fund valuation on faith, they also must accept Cliffwater's faith in other valuations. I mean, this is insanity. This is insanity. So, going back to what I was saying at the beginning, if you think there's no systemic risk here, I give you Cliffwater, because this shows us that Cliffwater, their assets, are the liabilities of another cockroach. And that cockroach's assets are a liability of another cockroach. And that cockroach's assets are a liability of another cockroach. So how can you sit there and say this is all, it might as well be one giant balance sheet? There's no differentiation. It's all one interconnected balance sheet. So if one blows up, they all blow up. It's just a matter of timing. And just to give you some context, we talked about them capping it at 5%. They say they're agreeing to 7%, but the redemptions hit 14%. Yeah, that's as of last week. I can assure you they're going a hell of a lot higher than that, which is the death spiral. Because then what do? Then they have to keep giving out these redemptions. And even if it is 5% per quarter, the markdowns, the real values of these things, it isn't even close to that, to where they could cover that. So what do they have to do? They have to go out and borrow the money. They have to go to the bank and say, hey, give me more money. Then it turns into a straight Ponzi scheme, because then what they're doing is they're borrowing money or somehow getting it from just the stupidest of stupid investors like pension funds, just so they can pay off the existing people that want their money back. The structural problem with funds like these is they're crooked as a scenic railway, number one. That's my editorial. But they say they promise investors short-term liquidity while holding long-term illiquid assets. Well, that's immoral. That's unethical. You can't promise investors short-term liquidity. That in and of itself tells you that they're crooked as a scenic railway, because they're lying to investors. Shareholders who stay with the fund bear the risk that someday it may have to sell assets at unfavorable prices. Yeah, like zero. Such as BlackRock. BlackRock came out last week and said, yeah, a lot of those loans that were on our balance sheet that we told you last quarter, 3 months ago, were worth 100 cents on the dollar. Actually, they were worth 0 cents on the dollar. That's how this plays out. It's that they keep kicking the can down the road to a point where investors can't get their money out because there's no money left. Because there's never any money to begin with, other than when they first got the money and then they flushed it down the toilet. It just in this ruse, this marketing ruse, telling the investors that it was somehow risk-free. So they take all the money from investors, they literally flush it down the toilet, and then they keep telling the investors that they didn't flush it down the toilet. They invested it wisely, and they're making this fantastic return. So whatever you do, don't take your money out, while they're sitting there collecting the fee. And if by some miracle they actually make money, then they get 20% of the upside. This is the ruse. This is how the game is played. And what we're seeing now is what happens when the chickens come home to roost. And trust me, we are not in the ninth inning of this thing. And if you're one of those people that think that this is contained like subprime or there's no systemic risk here, I've got some oceanfront property in Arizona that I would love to sell you at a great, great price. All right, guys. Just unbelievable, isn't it? It's unbelievable. Enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. If you want some more real expert insights on this stuff, you guys can check out the financial conference I'm doing in May. By then, who knows how much stuff will have hit the fan. But if you're going to go to Rebel Capitalist Live, this is the year to do it. This is the year to do it for sure. If you want more information on it, the speaker lineup and whatnot, we'll put a link in the description below. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing for freedom, liberty, free market capitalism, and full disclosure. Yay! And underwriting. Woohoo! See you in the next video.